All right, we are back on the Big Money Big Daddy Show. Dale Pieper and myself, Mark Conley. We are having a fabulous Thursday afternoon. We're excited about getting to the end of the week, and we hope you are excited too. Sorry, we had to come with some downer stuff on that, on the first segment, talking about the problems. People, when you first start out your career, you envision this big retirement and golf and walking on the beach, and it's going to be great. And then life hits you, and marriages hit you, and kids hit you, and maybe divorces hit you, and all this stuff happens. And at the end of the day, we find Americans living paycheck to paycheck. We find companies getting rid of pension plans. We don't even know if we can count on Social Security. Is that still going to be there? What's happening with the government? What are the issues there? And the reality is most people don't have enough saved. And it doesn't matter if you're 20, you're 30, you're 40, you're 50, you're 60. People are living longer. So you need to get started. And if you've gotten started, here's the two biggest problems that we see. Number one, people aren't saving enough. And that's, I think, a lot of times because they just stick their head in the sand. Like they don't want to run and actually create a financial plan that shows them if they're on track or not. I don't know. People just don't want to do it. They need to. And it's better to know the truth than to not. I mean, that's just the facts. And I don't think people are saving enough. And that goes for everyone. I mean, Dale and I, we've been doing this a long time it doesn't matter if you're high income or you're lower income, people just aren't saving enough because, even the higher income people, just because you make a high income now, well, you've got this lifestyle. You need to accumulate quite a bit of money to be able to continue to live in that lifestyle. I mean, according to some data, it shows 75%. It's really what we found when working on the plans. It's very dependent upon the type of person you are and what you want to do in retirement. So it needs to be customized. You can't just use these standard numbers. But I do know that most people aren't saving enough. I mean, I also know that from looking at the actual results of the returns that people get, they're not earning a high enough return. How do I know that? Well, Dalbar does a study. It comes out and it shows, it's a 30-year study and it'll show during different time frames. Markets generally are doing 9-10%, and investors are generally getting a 3 to 4% rate of return on all their money. That's not just their fixed income money. That's including their money they have in stocks, and that's a problem. So you're not saving enough. You're not earning a high enough return. So, we need to have serious conversations about the amount of money that you need to be saving, because I'm going to give you a rule that is a standard in the industry, and there's always new information coming out. Some people say this is 3%. Some people say it's 4%. Some models show you could even do 5%. But 4%, most experts agree, is the amount of money that you can withdraw from your investments if your intention is for the investments to be able to increase, to keep up with inflation, and for you to be able to take an income stream for the rest of your life. That's not a guarantee in any way, shape, or form. That's just a general rule that most financial planning journals will have information on. So in other words, what I mean by all that, if you have $1 million, you could take 4% off that, and that would be $40,000 a year. So everybody out there listening right now, take your income, and you can real quick calculate how many millions do you have to generate that kind of income, and you're going to realize real quick, wow, I need to accumulate more money. The good news, because that number is going to scare you, the good news, though, is if you invest properly, you have a financial plan, you protect properly, this goal is actually more achievable than you even think. But you've got to get serious about putting a plan together. So I'm going to go into, as we go through the show, 3 different strategies that I think will help you achieve the rate of return. Real quick, I do want to say a number, though, that just to help everybody listening right now, how much do you need to be saving? It does depend on your income. But if you're a higher income earner, you need to be saving about 20% of your gross income. That's right. If you ever want to be able to retire and have the same lifestyle, that's what you need to be saving. If you're a lower income earner, it's generally more around 10% of your income that you need to save. And that's simply based on the fact that Social Security should take care of more of the lower income. Now, you may want to assume that's not going to be there, and then you probably need to be saving the 20% too. But just that's a little bit of information that I think is important that gets missed. I think a lot of people, Dale, would you agree? I mean, it's almost like they agree they're not getting a high enough rate of return, so they always want to have that conversation.
Right.
But they don't want to have the more important conversation. And by the way, it is more important. Saving enough money, I'm going to say it, is more important than rate of return. If you save 20% of your income, even if you hire a bad financial advisor that gets you the Dalbar rate of return, you're probably going to be okay.
Right. You'll probably be better than the average investor.
Right.
I mean, it'll trump a rate of return any day of the week. So always saving more is always going to put you in a better position. The problem is, I mean, we see this all the time. I mean, just people are living paycheck to paycheck, just like we talked about. So, I mean, it's just one of those things people struggle with. So you got to get into the habit of paying yourself first and then living off the rest, where most people spend and they'll say, I'll save what's left over at the end of the month. And then what happens? There's nothing left over.
Right. So we do think you do need to get a good rate of return, because if you save enough and you get a good rate of return, hey, maybe that golf does come real, and the beach and holding hands with your spouse, So what are the strategies?
You don't have to have money to hold your spouse's hand, do you?
I thought you did. She won't hold your hand if you don't have any money.
She's trying to get the money out of my hand. She's trying to get the money out of my hand. Oh, my God.
Oh, all right.
We digress.
Strategy 1.
Yes.
What is that?
Own equities.
I think it's a good one. I mean, for as much as many of our co-radio hosts bash equities and talk about it's always the death, doom, and gloom, you know what? You should own equities. Now, to what degree should you own equities? That depends on your risk level. I mean, if we look over different time frames, if we just look over a 5-year period, and here I'm looking at the total market as measured by the CRISP index. So that's everything from your small companies all the way up to your big known companies like Apple, GE. And the rate of return of 100,000 would have grown to 175,000. That's almost a 12% rate of return. What about 10 years? Well, 100,000 would have grown to over 200. It's about a 7.5% rate of return. Or if I go 20 years, it's about 8.35% rate of return. And 100,000 grows to almost 500,000. So, 30 years, it's over 10. And the further you go out, if I go all the way back to data, it's still slightly under 10. That's just the reality of what it's done. Now, I get it. That's not been your experience with equities, but there's some reasons why. And those reasons are, I think, some of the deadly mistakes that we're going to discuss in the last segment. People are making these mistakes, and they're making them all the time. Because those numbers I just gave you, if you were getting those rates of return, I think you'd be happy. I think you'd meet your financial goals, your college planning goals, your retirement goals, your cash flow goals. But I'm willing to bet, because I got a lot of experience, been doing this for 20 years, looking at real life, what people are getting, and they're not getting those returns. But those are really, they were there for the taking. What the future has, hey, I don't know. But I know that equities, which by the way is just companies that are out there trying their darndest to make a profit, regardless if we're in a boom time, a recession, a depression. Don't think of the stock market as just some thing that's out there. It's owning companies that are trying to make money. And hey, when I invest properly, and I'm properly diversified, I own a lot of those companies. Some make it, some don't. I get that. But when I look at the total return of the market overall, if I'm owning all those companies in that CRISP 1 through 10, those are the real results.
Right. So the truth of the matter is you shouldn't be scared of the market. When you look at those numbers, those are actually good results. So for someone to say, oh, you should be afraid of the market or the market doesn't produce returns. I mean, have you ever really looked at them?
Psychologically, here's the reality. If you scare people, that makes them move faster than the truth of what you stand to gain. I mean, that's just the reality. I think that's why there's such a huge business in fear mongering. And I mean, the media is like totally figured this out. I mean, they know if they have negative headlines, and for those of you out there in business, marketing 101, if you have negative headlines, scary headlines, you're more likely to get interest than if you have something positive. I don't get it. That's just how it is with human nature.
Yep.
But I need you to see through that because God gave us this wonderful brain. Let's think through the hype. Are there scary things? You bet there's scary things. Are there things you should be concerned with? You bet there's things you should be concerned with. But can we not agree that some portion, not all, of your money should be taking advantage of capitalism and equity growth that's been out there? Because how else are you over time going to beat inflation? I mean, that's a big deal because the cost of things keeps going up. We need to beat inflation. I mean, and sometimes I talk to clients who are like, well, I'm retiring now. That's not that big of a deal. I mean, if you're age 65 and you're married, you still might live 27 more years. There's going to be inflation. I mean, in 1975, a stamp was 10 cents, and in 2016, it was 47. Gallon of gas in 75 was 57 cents, and now I remember what it was yesterday. The average, it was $2.21 on 2016. What about a new home? I think people relate to this one. 1975, $42,000.
I did not pay that for my house.
And now it's $365,000. If you're going to beat that, you've got to have a portfolio that has some equities in it. I mean, just call it what it is. So you've got to find a way to invest in equities that you can be comfortable in, and that's part of how it's got to be personalized within whatever risk level you're comfortable with. And that's one of the things that we do. And it's something that you're interested in is I'm telling you what the returns of the market were. If you haven't been just consistently getting that, there might be something wrong with your portfolio. Let us take a look at it. We have a software system that does an analysis, a mathematical analysis of your investments. We call it the portfolio MRI. Give us a call, send us an email. Let's just set up a time. We'll run it for you. And we will give you just a quick insight into the MRI and look into it and tell you how you're investing. We'll be able to give you the exact reasons as to why the returns may or may not have been what you expected them to be. And we're going to tell you what the risk level is. I think sometimes we think stock market high risk. Well, sure, if you took 100% of your money and put it in the stock market, there's a lot of volatility. I'm not denying that. You could take all your money, put it in the S&P 500, and the returns are great, sure, but the risk is super high. What if there was a way to get those same types of returns, but with significantly less risk?
Another reason people probably don't get good returns? Their money manager might be a sociopath.
That is possible. And if you want to figure out if your money manager is a sociopath, you need to come to the next coaching session that we are having. I mean, I know it's a cool topic and it'll be interesting. We'll give some examples. We'll tell some stories. But we're really going to, because maybe they're not so crazy, they're just stealing your money. But maybe you've potentially, we talked about madmen. Maybe you've hired a madman to, in effect, gamble and speculate with your money. Think about this. What if one day you went to the casino and instead of going in and playing blackjack and gambling, there was just someone outside that said, "Give me your money. I know what I'm doing." Would you do that? Well, we're going to discuss that. And if you are interested in coming to this event, or for that matter, just hearing about all our upcoming events, just text the keyword DADDY to 72727, DADDY to 72727. You also can just email us at BMBD for Big Money Big Daddy at wealthdesigngroup.net or call us 713-826-0426. We'd love to have you at our event. It fills up fast, October 23rd, 6:30, Papados.
Big money, big daddy.